DFA, a fund company that we know and love. We talk all the time about. We use at our own firms. They ran a really interesting study, 6,000 different companies that they surveyed and got the data on dating back to 1991. They found consistent underperformance across IPOs, right? That as soon as an IPO, it underperformed by about 20% over the first 3 years from day one. That's
Yeah,
pretty
now
bad.
that actually builds into the mechanics of how traditional IPOs work, which I was referencing a little earlier.
Yeah.
So the way it traditionally works is retail investors don't get the IPO price. They have to buy the day of the IPO in the open market.
They're
So
last in line, right?
they're last in line. So you're not you're hold in a sense you're holding the bag, right?
Mhm.
If you want to get in on the first day, you got to end up holding the bag at the higher price. Because the way it works is they go like, we're going to release, X number of shares, and they go around and they sell big blocks of it to all these big institutional investors. Maybe some individuals within those institutional investor companies get some shares. Definitely their funds do. And then what happens is when they release and it pops, they go and they can sell it. So a really simple example would be DoorDash's IPO. You know, basically underwriters deliberately underprice to generate buzz, and then institutions buy at the IPO price. Retailers buy after the pop. So DoorDash opened at $182 on IPO day against $102 IPO price. So any institution that sold those shares to retail investors that day made 78% overnight. But then what happens is there's a lockup period for the employees of the company. So for a lockup period of either 90 days or 180 days, they're not allowed to go sell the majority of their shares. They have to wait. And once they can that kind of like timeline is lifted, they flood the market with shares, and that brings down price because it's supply and demand, right? If there's only 100 shares available and there's a lot of demand, it's going to drive up price. But now if there's 10,000 shares available and there's not as much demand, it's going to drive price down. That's just the way markets work. And so for that, you end up seeing this data with DFA that IPOs on average underperform the market by 20% over 3 years from the first day close. That's not saying the IPO price, that's saying the first day close, right? Now, traditionally, retail investors aren't allowed to participate. The thing that has me worried about this is they want 30% participation of investors. To me, that means they want people like the executive that reached out to me to go like, SpaceX is a moonshot. I want in. I want to participate. It's going to do great. They're not paying attention to the fact that it's trading at 94 times revenue, pardon me, can't trade on earnings because we don't have positive earnings yet. When nothing, I don't know if anything's ever traded at revenue that high. That's actually the question I'll ask after the fact.